The question really is, can the RBI continue to put a lid on yield increases when global yields are surging?
We think the RBI's reaction function is slightly getting misunderstood. What they're trying to do is trying to control the pace of yield rise, which is what they mean, we think, when they say an orderly evolution of the yield curve, and not really trying to put a line in the sand, let's say, where the 10-year bond is concerned. So, one must understand that yield curve control is strictly outside the domain of emerging market central bankers. And it's too tall a task to ask of the RBI, and that's exactly not what we think they're trying to do. The Indian yield curve continues to be very steep even at mid-duration points. So as long as they can control the pace of evolution of the yield curve, I think they're hoping that some of the commercial demand for bonds will also continue to sustain.
Having said that, what tools are still available for the RBI to put a lid on borrowing costs?
So, there is one aspect of monetary policy which is kind of a global constraint now. If you look, in most places across the world, monetary policy seems to be conducted on a state-based guidance, which is that we will do so and so till growth comes back. Now, the problem is that we have entered a year where economic data is going to jump around quite substantially because we are exiting a large period of lockdown, some to and fro there notwithstanding. And therefore, people's economic forecasts are going to be very divergent from one another. So one of the things that, probably global policymakers have to, at some juncture, try to do is either strengthen the state-based guidance or introduce time-based guidances. And with the RBI as well, the state-based guidance is almost coming to an end. Rather, the time-based guidance is coming to an end, and the state-based guidance is difficult to interpret. So one is, strengthening the forward guidance in whatever form or fashion they can without locking themselves in. The other is, their support of market bonds through open market purchase operations will probably continue. Our own suggestion has been that they should move to more screen-based buying, which is to say that, don't show your hand every day, but actually come into the market, make your presence felt from time to time, but don't commit to a forward calendar, which can be upfront discounted by the market. They have also given certain dispensations on the held-to-maturity ceilings on bonds, which they can potentially extend, coinciding with the revised fiscal glide path of the government of India. So there's some things that they can do. But fundamentally, one has to appreciate that India's bond market is not as deep as it used to be. Risk appetite for many market participants has actually withered slightly over time, and that liquidity doesn't necessarily always translate into risk appetite. So risk capital and liquidity are two different things. So you can have adequately surplus liquidity and still lesser risk appetite from bond market participants. But we think, some of these things is what the RBI can do to potentially control the pace of rise in yields.
Absolutely. So, Suyash, I want to get a sense of, how close Indian bond markets are to being included in global indices here, global bond indices. And, if they do get included, it could be a game changer, couldn't it?
Well, this is something that one continues to hear, and the impression clearly is that there is a very active and strong level of engagement to get us through bond indices. Having said that, I don't think the Indian bond market is pricing in any meaningful inflows from offshore investors for at least the financial year ahead that runs between April 21 to March 22. We think, whenever it starts to happen, it will be a slow scale up. One other aspect that one thinks about is that with India's cyclical recovery now taking a stronger form, and remember this is happening after a gap of 4 or 5 years, one can reasonably be optimistic, maybe not wildly so, when one makes the statement that as India's credit profile improves over the next 2 or 3 years, it may start rubbing off on the bond appetite for offshore investors for India as well. So one is the push factor, which you allude to, which is inclusion in bond indices. I am hoping that over a period of time, and it looks like a bit of a wild speculation as of now, but over a period of time, as the credit profile of the country improves, some bit of a pull factor would also start to emerge. One of the aspects there also is a clear, sorry, go on, please.
Suyash, I want to get to essentially what you talked about at the beginning of Haslinda's first question, and it was to do with how much these central banks in emerging markets can actually do about managing their yields. And so are you suggesting that the Operation Twist that the RBI has been conducting is essentially not doing very much ultimately?
It is proving to the market that RBI stands ready to regulate the pace of change of yields. Remember, I referred to limited risk capital being available in the market, and what is there needs to be deployed in a meaningful and productive fashion, and that's what I think the RBI is trying to do. So the bond operations that they're doing actually are quite precious to the bond market, because they do put, their stated objective of an orderly evolution of the yield curve. They provide more weight to that objective because the RBI is actually acting as it speaks. Again, I would say, and I don't think the bond market is interpreting necessarily it that way, but some people might be, they are not trying to control the level of the 10-year bond yield. That is too ambitious a project for a emerging market central banker. They are merely trying to control the pace of change. And that's how I think we would read the bond market.
Suyash, before we let you go, just a question on the rupee. It's been pretty strong, in fact, the best performing currency in Asia this month. Do you see rupee strength sustaining, and if so, could that derail India's recovery story?
So, we think there is a bit of a shift in the way RBI looks at forex reserves, and an offshoot of that is then how the rupee behaves. So, we had a period where the RBI was focusing on some sort of a rigid inflation targeting and let that be the anchor variable for policy. FX was more like, for smoothing out of movements in the currency. Now we think the RBI has moved to a flexible inflation targeting regime in truth, which means that inflation can bounce around 4%, doesn't necessarily needs to be at 4%, and RBI will not react very hawkishly. But at the same time, to compensate for that, they have really stepped up creating buffers for on forex, which does mean that compared to the kind of flows that India sees and is likely to see over the next couple of years, the RBI takes away quite a bit of that into its own reserves.